Mark, very good to see you. We are myth busting today. We have the four biggest financial myths and the truth behind them. Some of the most common beliefs about money, retirement, and investing are myths, and believing in them can really hurt your financial future. So, here are the top four. Myth number one: the market always goes up. How do you help clients stay realistic about market cycles while staying invested for the long term?
Well, that's a great question, Aaron, and thank you so much for having me again. One of the things that we discuss with our clients is really understanding market cycles on the front end because we know that trees don't grow to the sky, and there's events that are going to happen that we don't know what those events are that are going to create drawdowns or market declines. And ultimately, yes, from time to time, we're going to be in recession. So we can talk about all the statistics, like on average, we have a market decline of 10%, but really it's about educating on what we call sequence of returns risk. Because as we
Mm,
get closer to retirement, really what we need to do is de-risk the portfolio in a way that if these events happen, it doesn't affect our retirement date. And because, if you think about it, if we take a 30-40% hit in our retirement assets a year before we retire, we're going to be rethinking that option. So it
absolutely.
really gets back to the planning aspects of it and helping the clients and the community really understand how to go about strategizing to de-risk their portfolio, but get the returns they need to meet their goals and objectives.
Mm, okay. Myth number two: the 4% rule for retirement withdrawals. Is this rule still reliable? Is there one number that is?
Well, this has been thrown around for many years, and
Right.
initially this came out in the 80s or 90s, and it was based on, you have to look at what it was based on, like retiring at 65, and it was a 50-50 portfolio. But again, things have changed. Interest rates have come way down. You can't make that assumption that you're going to get a 6 or 7% on a bond fund. So a lot of experts have dropped that to 3%. In our opinion, there shouldn't be a rule because again, it's really stress testing your retirement income plan and saying, okay, if I live too long, what is a withdrawal rate based on the assets I have, based on the guaranteed income that I have coming in, and what's really going to work? So the answer is it really depends.
And now let's talk about myth number three: my taxes will be lower in retirement. Why might retirees end up paying more than they were expecting?
Well, I think the big reason is especially for people that have been good savers.
Mm,
They dotted the I's, they crossed the T's. And when they get to retirement, now they're pulling out, and they may be pulling out less, but again, ultimately, they're going to be forced to take out more. And this means they're going to get to that required minimum distribution age of
right.
73 or 75, and the government's going to force them to take money out. Well, ultimately, for many people, they're going to have to take out a lot more than they were expecting. This is going to throw them into higher brackets. It's going to create potentially Medicare surcharges on their Medicare Part B premiums. And remember, a lot of people, they lost all their deductions. Their kids are out of the house. Their house is paid for. So really the myth is, hey, you are probably going to be in a higher tax bracket. And we're on the precipice of, you know, really having problems with our debt. So ultimately, we have to take advantage of these low tax rates because tax rates down the road, 5, 10 years at some point, are going to be much higher than they are today because we can't get out of this. We have to pay down these deficits.
Right. In fact, is we are living in a historically low tax rate. Great point. All right. Myth number four: I don't need life insurance once I retire. Why would someone need life insurance in retirement?
Yeah, and we're not advocating that everybody needs life insurance, but let's look at it objectively because, if we had a couple that one was terminal, let's say, or didn't have a long life expectancy, well, when one spouse dies, we're going to lose cash flow to the household, Social Security benefits. Yeah, they're going to step into the higher amount, but nonetheless, less money's coming into the household. Secondly, that now they're a single filer, their tax rates are going to go up. In fact, they're probably going to pay double what they were paying more as a percentage of their income. And then, so life insurance can help replace that.
Mm,
Secondly, if you have a long term care benefit attached to it as a rider, now I can use it as a living benefit. Or if I don't need it at all, I might want to use it as a wealth transfer vehicle tax free to my kids.
yeah. Yeah, good point. You know, Mark, it's great to talk through these myths with you. I'm sure that a lot of people will watch this video and recognize that maybe they were relying on these myths as facts. So if they want to talk through the reality of retirement with you, what's the best way to reach you?
Yeah, so just pick up the phone, give us a call. The phone number is 303-681-0113. Anybody on our team, we'd love to chat with you. We can set up a Zoom meeting in person, whatever it might be. But you can also go to our website, mcgregorwealth.com.
Great. Mark, thank you so much for your time today. I really appreciate it.
All right. Thank you, Aaron. Have a wonderful day.